The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Please consult your tax advisor, even if it's us, to find out how this may apply to your specific situation.
Hey listeners, and welcome to Tax Trails. On today's episode, we're going to be interviewing the managing partner at Larson Company, Greg Denning. Here are your hosts, Derek and Spencer.
Thanks, Chandler.
Thank you, Chandler.
Yeah, so today we're really excited. We have our managing partner here at Larson Company, Greg Denning. Greg, welcome to the podcast.
Thank you. Glad to be here.
Good. So to get started, how about you give us a little bit of background on yourself, where you're from, and why you're at Larson and why you're in tax and all that good stuff.
Okay, will do. I grew up in Richfield, Utah. Did the normal things of growing up in Richfield, shooting BB guns, catching lizards, riding motorcycles.
That's good stuff.
The classic things.
Playing lots of sports and mostly basketball.
Awesome.
And then I went to BYU, graduated with my master's and bachelor's there. I also attended, at the time it was called Utah Valley Community College. It's now Utah Valley University. But
Got it.
Attended there, got my associate's degree. When I graduated BYU, I went to work at Deloitte for about 14 years in their San Jose and Salt Lake offices.
Awesome.
I was also part of a national group and did a bit of traveling my last year or two at Deloitte.
Okay.
After I left Deloitte, I was basically on my own for a couple years, and then joined up at Larson, and I've been here about 18 years. I was introduced to Dennis, the founder of Larson Company, by his son Greg.
Greg and
I
Greg.
work.
Greg and Greg.
Yep, Greg and I. I'm now referred to in the Larson circles as Work Greg. And Greg introduced me to his dad, Dennis, and Dennis and I headed off and have been here ever since. So
Awesome.
that's kind of how I ended up at Larson.
That's cool. So initially, you got your master, you got your schooling done, and did you know right away you wanted to go into tax?
Well, I never really knew what I wanted to do, audit or tax.
Yeah.
But one spring semester, I took an audit class. They were talking about tick marks and all these other names and things I didn't even recognize. I didn't have the slightest idea what the heck they were talking about. And still to this day, I don't think I understood that audit class. So I knew audit wasn't for me because I didn't understand what the heck was going on with that class. And so, I really enjoyed the financial aspects of those courses.
Sure.
But I thought, well, tax sounds like the right spot for me. So
Cool.
kind of a shot in the dark, but went into tax.
And it worked out.
Worked out so far.
To this point.
To this point,
Up till now, it's worked out. You never know what's going to happen.
yeah, still to be determined.
Well, we're lucky to have you here at Larson. We appreciate all the work that you're doing, especially as managing partner. That's awesome. But why don't we just go ahead and kind of jump into this topic that we have. And you kind of wanted to talk about tax provisions. And for those who aren't in the tax world, or maybe are in the tax world but might not have heard of tax provisions, can you kind of just give us a rundown of what tax provisions are, essentially?
Yep, I'll give you a little bit of a rundown, and feel free to ask any questions as they come up. But
Okay.
Tax provisions must be included with all GAAP financial statements. So if
Okay.
you're issuing a GAAP-related financial statement, you have to include basically your tax footnote, and you have to include certain items of tax in there. And so some of the basics are that you have to report what your current taxes payable are
Okay.
on your balance sheet. And you also have to report the future tax consequences of certain items or events, because the timing's not always the same between audit and tax of when things get recognized. So you have to report your deferred tax assets or deferred tax liabilities on your financial statements. And one of the main things related to tax provisions is that you have to make sure the balance sheet is correct.
Okay.
And then everything else falls out to the income statement. So you make sure your deferreds are correct and your payables are correct, and then basically everything else goes through the income statement.
Interesting. Yeah, I feel like, when we work on companies, they could have a substantial tax bill.
Mhm.
And I believe from what you're describing, tax revisions would help to anticipate that tax bill and let, whether it be investors or outsiders of the company who are looking at their GAAP financials, and GAAP is generally accepted accounting principles, it would help them to know kind of the financial health, if you will, of the company. Do you think that's kind of a good?
Yeah, and it also, lets the investors know kind of what the tax position of the company is, whether they're a tax-paying entity or maybe they're in a loss position right now and they're not paying taxes. But it helps those investors kind of know what their current tax expense is and what their deferred is, meaning the deferred is basically talks about what either my future taxable items will be or what my future tax deductions might be. And so that's rolled into the tax provision on the balance sheet of what future items may be taxable and what future items may be tax deductible.
Okay. So what kind of things make up those future items? So I'm thinking, hey, I have this activity that happened this year. What are those things that are making up my deferred either, tax liabilities or tax assets?
So there's basically two types of components when it comes to a tax provision. There's permanent items that that may be recognized for book and never recognized for tax, or vice versa, recognized for tax and never for book. When you think of permanent items, those generally look for items off the income statement. For example, probably the most common one is meals and entertainment, where for tax you only get to deduct half of the meals and entertainment that shows up, on the books, where books deducts the whole thing.
Got it.
And so that's a permanent reconciling item between your book income and your taxable income.
Got it. So we take half of it, and we don't get to pick up the other half at some date in the future. It's just gone forever for tax purposes. Okay.
Yep.
Got it.
So, but kind of the question you were asking, Derek, it tends to be what we call temporary items
Okay.
that have a different timing. And generally you're looking at balance sheet items. So if you think about a bad debt allowance and accrued vacation, it's generally some allowance or vacation, or excuse me, some type of allowance or accrual that you look at. So for tax, you can't deduct bad debt allowances. The debt has to be certain before you get a write-off for tax purposes, right?
Okay.
Or same thing with accrued vacation. Just because you've accrued it, you can't deduct it for tax until you've actually paid it.
Okay.
And so those are some of the balance sheet items you look at and say, okay, what's my timing difference of when I'm going to deduct it for book versus when I'm going to deduct it for tax?
Okay.
And so, for example, and you also look at fixed assets.
Okay. Yeah.
So
I think
depreciation
that's a pretty big one.
is a very big one. So, in recent history, tax, you've been writing everything off with 100% bonus depreciation, right?
Yeah.
And books probably writing off most of the fixed assets over a 5 to 10-year period or whatever, right?
Mm-hmm.
And so that generally becomes a deferred tax liability
Yeah.
for tax purposes, because for tax, you've taken that deduction now. And for book, you're going to be deducting that over the next, say, 5 to 10 years. And so your taxable income is actually going to be higher in those years than it is currently. So that's a future liability that you're recording on your books.
Interesting. And that would be really good to know as an investor of a company, if they see all these assets and then they see their tax payment, they're like, oh, they didn't pay much, or maybe they had a tax loss because they were able to accelerate all that depreciation. Yep. But then, hey, in the future, you might want to know those accelerated deductions aren't going to be showing up later in the next couple of years.
That's correct. Those are going to basically flip and make your taxable income higher than your book income. So you're correct on that. And, one of the other deferreds that you'll see, a deferred asset anyway, is when you talk about companies with a loss, maybe an NOL, a net operating loss. And so that creates a deferred tax asset on a company's balance sheet.
Mm-hmm.
But that leads into another discussion, whether you get to actually record those on your books or not.
Okay.
You may record them, but you may have to record what's called a valuation allowance against them, saying what's the likelihood that I'm actually going to be able to utilize this deferred asset in the future.
Okay.
Interesting.
And so if you've got deferred assets, there's a little bit of extra work that you have to go through to see if you actually get to book them as an asset on your financial statements. The threshold is you basically have to be at a more likely than not position that you'll actually get to use them before you can record them as an asset on your books.
Got it.
Interesting. So what's kind of the process of working with or doing this sort of tax provision? Is this more, do some firms or do some companies do it in-house, or is it more outsourced, and what's kind of the process of that?
It depends on the company itself. Most companies aren't big enough to have an in-house tax department to do those calculations for them. So generally, a lot of times it's their tax preparer that will do the provisions for them and help them calculate that. And it's something you have to generally do earlier in the year because they're trying to get out their audit reports. And so generally they'll outsource that to their tax preparer, and they'll do all the necessary calculations to figure out what gets recorded on the books of the company.
Okay.
So you mentioned you need a tax provision when you've got GAAP prepared financials. So what kind of companies are need that? Is it just your, small little,
Mom and pop shops?
like a dog grooming business or something?
Like a startup dog grooming business.
Yeah,
or
what? Who really needs to look at getting a tax
The
provision?
main companies that need that are publicly traded companies.
Okay.
So if you're a publicly traded company, you have to, you have an audited financial statements. You issue your 10K that discloses all that, has the tax footnote, puts that information in there. If you're a smaller company with investors, maybe not public, but maybe you have private equity owners or a diverse group of owners that want audited financial statements, those also include a GAAP or also include a tax provision in them.
Got it.
And maybe some borrowers have to have an audit report to submit to their bank. And so the bank may require GAAP financials that would include the tax provision.
Got it.
Interesting. Would a company, let's say we have a company that's not a publicly traded company and they're not, huge. They have a couple million in revenue, maybe up to 10 million. But let's say someone's wanting to buy into the company. Would that be maybe a beneficial thing to have a tax provision? I'm just trying to think of what would be a benefit for those who might not necessarily need one.
Only if their investors are wanting an audit.
Okay.
I mean, I've never seen a company that goes, hey, let's do a tax provision that's not issuing an audit at the same time.
Yeah.
Okay. I mean, some companies may ask you for an estimate, but
it's not the same thing.
It's not the same thing.
Right.
It's not the same thing. They're really only done if somebody's issuing audited financial statements.
I guess at a high level, it really is just a taxable income calculation, right? I mean, at the most simplest level. No, you wouldn't say
correct,
that?
Derek.
Okay.
If you remember what I talked about earlier, that the balance sheet's the most important thing for a tax provision.
Yeah.
The book to tax calculations you're talking about, that's kind of the easiest part of the tax provision.
Yeah.
The rest of the tax provisions, making sure your balance sheet's correct, that your deferreds are recorded correctly, and that your payables are recorded correctly. And there's a lot that goes into making sure the balance sheet side of things are correct.
Got it. Yeah.
And so the easiest part of the tax provision is the book to tax.
Right.
Most of the time is spent making sure your balance sheets are correct, that your tax accounts are reconciled, that you've taken into account the fact that only income taxes are going in to the tax accounts on the financials, either on the balance sheet or the income statement.
Mm-hmm.
So
Got it.
the process of making sure the balance sheet is correct, I'm assuming that creates a lot of back and forth with the preparer and the client. And like, I'm assuming, are you talking about like we need to get like source docs of, making sure our assets tie out to where we have like bank statements and those sorts of things?
Well, generally we take the financials that the client gives us.
Mm-hmm.
And generally clients that have tax provisions have a pretty sophisticated accounting system and accountants
Mm-hmm.
that are in-house that give you a good trial balance and those kind of things to work from. Where we usually get we usually don't go back and ask for source documents or things like that, other than the fact that we may need detail of what's in their tax accounts to make sure we can reconcile them and understand what payments have been made to the IRS, state taxing agencies or things like that. Because sometimes what you'll see is taxpayers will maybe slip a sales tax item in their income tax account, and that needs to be adjusted for. So
Got it.
those are kind of some of the things that you take into account and do there.
Interesting. Did you do a lot of tax provisions while at Deloitte? Is that something that you were pretty hands-on with? Or?
Yeah, I did quite a few there. And then when I left Deloitte, I became an outsourced tax director for a number of public companies here in the Salt Lake Valley.
Oh, okay.
And that's kind of what I did for a couple years, was doing their tax provisions. Because when I left Deloitte, it was about the time Sarbanes-Oxley came out, which required more independence between their auditor and the client. And so up to that point, a lot of times the accounting firms would prepare the tax provisions as part of their audit, but they really need the client to take ownership of the preparation of the tax provisions. And so that's what I started doing for, several companies that I worked for, doing their tax provision, then submitting it to the auditors to then have it reviewed.
Wow.
Cool.
Wow. So that would be so you would say kind of tax provisions are a little bit of your, what you would say, bread and butter.
Yes, they have become that.
Out of necessity or out of liking, I guess?
It's kind of like, I don't know if like's the right word, but I like doing tax provisions.
Okay.
Because tax provisions to me are a puzzle.
Yeah.
Where you have to marry tax law with accounting principles. You have to understand the tax law, but you also have to understand how things were booked for GAAP purposes so that you can make the correct book tax calculation and difference, because those differences become part of your deferreds that you record on the balance sheet and those kind of things. So to me, it's kind of the whole picture of the company's tax position, and you have to make sure, and this is a weird accounting concept, but you have to make sure your debits equal your credits. Because a lot of times, if you're just preparing a tax return, you're booking basically one-sided entries
Yeah.
to get to their taxable income. You're not necessarily looking at both sides, your debits and credits. But with the tax provision, like I said, you got to make sure your debits equal your credits.
Right.
To make sure that everything's complete for the financial statements.
You sound like a very passionate man.
I've probably just been doing it for a while now.
No,
But like I said,
that's awesome.
It's a puzzle that you have to fit all these pieces together in a relatively short period of time.
Yeah. So talk a little bit about that. So like provision season can kind of it's like tax season, but even heightened.
It's tax season compressed into when companies need to get out their financials, right?
Yeah.
And the one thing about tax provisions is you are never the first one done. Meaning
That makes sense.
The client has to finish their books
Yeah.
and have them closed, all their accounts reconciled, and then once they're done with that and they give you the completed trial balance, then you can start your work.
Yeah.
And then they're, Are you done yet? Are you done yet? Are you done yet? Well, I just got started,
Yeah.
And so you're always the last one done, but there's really nothing you can do about it because you have to wait till everything else has been completed.
That can be cumbersome, I bet.
It can be intense.
Yeah.
Awesome. Well, thanks so much, Greg. We appreciate you coming on and kind of opening the door to the world of tax provisions. Is there anything else that you wanted to talk about, that you wanted to bring up? Anything maybe super important about tax provisions that we didn't talk about already?
Well, just a couple things I've noted over the years.
Yeah.
One thing I found out kind of early on, that the effective tax rate can be a lot more important to the client than what their cash tax payables are.
Interesting.
I always thought, clients are mostly worried about, well, how much cash do I have to pay for taxes?
Yeah.
At least on the public side, they're really interested in what their effective tax rate is.
Okay.
So not necessarily the hard cash out number, but what
Their percentage
what that number is
relative.
compared to.
And how it affects their net book income.
Yeah.
If you got a high effective tax rate, they got a higher tax expense and lower book income. And so their effective tax rate can be one of the most important things to them.
Interesting.
Yeah, because I always thought, you want to reduce the amount of taxes you owe, but there's some companies that are more worried about what their effective tax rate is.
Interesting.
Is that because of why is that, do you think? Is that because of and that's what they think investors are looking at?
Mm-hmm.
Okay.
Yeah, because it could affect their rate per share,
Okay.
things like that. So
Interesting.
they become very concerned about what their effective tax rate is.
That's really interesting.
You wouldn't think that.
Yeah, I mean, from our point of view, I always think, I need to reduce the amount of taxes that a company owes, or making sure they're paying the minimum. But a lot of times the CFO and controller or president of the company are going, okay, what's my effective tax rate? That's what's
The big number they're looking at.
Yep.
Interesting. Awesome. Yep. Well, thank you, Greg, so much, and thanks everyone for tuning in and listening.
Yeah. Yep. That was awesome. It's fun to learn from a wizened, tax.
A seasoned tax professional.
Yeah,
That's not what you wanted to say, Dan?
Yeah.
Wise beyond his
I didn't want to
years.
say a wise old man, but
Awesome. Thank you, everyone.
thanks.
For more information about Larson Company and other educational material, you can find us at our website, larsco.com, also linked in the show description. For questions or suggestions on future episodes, you can contact us at larsonpod@larsco.com. If you would like to learn more about today's episode topic, additional resources can be found in the episode description.